As of the time I'm making this video, year to date, Meta stock has fallen by over 70% due to slowing growth and costs notably in the metaverse. Google's parent Alphabet share price has fallen 40%, erasing all their 2021 gains. Amazon and Tesla stocks each has tanked about 45%. Nvidia and Netflix stocks each has taken a 50% plunge, not to mention a bunch of other tech companies that recently have been doing layoffs. Tech companies, big or small, their stocks are absolutely collapsing this year.
For most of us, this may be a once-in-a-decade opportunity to buy some of these stocks. In today's video, though, I'll be talking about what it means for employees that are working in these tech companies,
and I'll be revealing the big mistake that can potentially cost a taxpayer thousands of dollars in taxes. Hey everyone, welcome to my channel. I'm PanQ. When you are signing a job offer, one of the most important things you are looking at will be compensation, of course.
Note that I'm talking about total compensation, which includes your base salary plus bonus that will be paid out to you on an annual, semi-annual, or quarterly basis, plus a signing bonus, and last but not least, your stock-based compensation. The SBC represents a good portion of an employee's pay. The types of SBC, depending on the company, for startups can include SOs and non-qualified stock options, or RSAs, and for late-stage startups and publicly traded companies, they'll likely give out RSUs, and for publicly traded companies, they normally also offer their employees the opportunity to participate in their employee stock purchase plan known as ESPP. Today, our focus is RSUs. RSUs stand for restricted stock units, and typically your initial grant, your job offer, will be vested over 4 years. I do see some companies have a 3-year vesting schedule, but most of those tech companies do 4 years. That's why you usually see a cliff in 4 years when the initial grant runs out. Each year there will be a refresher though. There are times when the refresher can end up outweighing 1/4 of the initial grant, for instance, if a person gets a promotion. Let's look at one example. Say you got hired by Facebook back in September 2020, now known as Meta, and you were granted $200K worth of RSUs. Since the stock price in September 2020 was $250 a share, essentially you were granted 800 shares of RSUs. That's calculated by 200K divided by 250, and that were put into your restricted stock plan account. You'll see the value of your account fluctuating every day. By the end of your first year, 1/4 of your initial grant, that's 200 shares, would be vested around the company's September 2021 stock peak at $380 a share. And once the RSUs were vested and released to you, the stocks would be transferred from your restricted stock plan account to a regular brokerage account. You were so happy about that. Not only 200 shares of stocks were finally yours, but the shares also appreciated in value. 200 shares times by 380, that's $76,000 worth of Meta stocks. There's only one question. Uncle Sam and probably your state are going to take the slice of the pie. I live in California, the state with the highest state income taxes. Let's say if you happen to live in California too, 42% of that $76,000 would likely have been taken from you, and here's the breakdown.
Federal income tax, depending on your tax bracket, I'm using 24% as an example, that'll be $18,200. US Social Security tax, that'll be 6.2%, that translates to $4,700. Social Security earnings was capped at $140,000 to $800 in the year of 2021. So if you've already made that much before your RSUs, then this would not be applicable to you. Then that's Medicare, 1.45%. So that'll be $1,100. This one has no cap. Last but not least, California income tax, roughly 10.23%, which will be $7,800. So in total, that'll be $31,800 taxes on your vested RSUs in your first year. The reason RSUs are being taxed so much is because they are treated as earned income for tax purposes. At this point, you would still have $44,200 worth of Meta stocks. Well, you didn't sell your stocks in 2021, and fast forward to today, your Meta stocks are now worth $10,500.
Now you think the company's fundamentals have changed, and you are selling your stocks now as you don't want to take any more risk. Next year, when you file your 2022 tax return,
you might want to check what your CPA would be doing, because the ugly thing is your CPA might wrongfully report the $10,500 as capital gains, and in that case, you'll be paying another 34% of taxes on that portion, which translates to $3,600. Now your original juicy $76,000 worth of RSUs just becomes a meager $6,900 that you can pocket.
You're like, what the hell is going on here? before I review the mistake. If you think the content is helpful, please hit the like button. Okay, let's come back to the problem. When you sold your stocks, there will be a 1099 issue to you. Now, I'll introduce a very important concept, which is basis. Usually, basis is just how much it cost you to initially purchase the stock. But when it comes to RSUs, the IRS sees each vest as a purchase. Well, I saw some people, even CPAs, just use the unadjusted cost basis reported in the first couple of pages of 1099, which will show zero. However, if your brokerage firm does a good job, and most of them do, like a Fidelity or E-Trade, you should see an extra page in the 1099 that will lay out the adjusted basis of the RSUs,
which in our example under the net proceeds method should really be $44,200. So instead of a capital gain, you actually incurred a capital loss that's calculated by $10,500 sales proceeds minus $44,200 adjusted basis. So your capital loss should be $33,700.
The CPA will need to combine both pages of info from your 1099 in order to correctly report the transaction on your 2022 tax return.
Before I continue, the video and the idea presented in it are for informational purposes only and should not be construed as tax advice. You should consult with your financial or tax advisor.
If you work at those companies, Meta, Google, Amazon, Tesla, Netflix, Snap, etc., and you had RSUs vested when the stock reached at its peak last year or beginning of this year, you might want to consider selling a portion of your stocks now. That way, next year when you file your 2022 tax return, you can use the losses generated from your RSUs to offset some of your other gains. But here's the deal. Number one, you cannot reacquire the stocks within 30 days. Otherwise, a wash sale transaction will be triggered, in which case you won't be able to claim a tax deduction. Also, if you are participating in your company's employee stock purchase plan known as ESPP, figure out your company's ESPP's open window period and do not sell your RSUs 30 days before and 30 days after that period. Number two, you can use the capital loss in our example to offset your other capital gains, but at the end of the day, you can only write off $3,000 of net capital loss in 1 year, and if there is any remaining capital loss, it will be carried forward to next year. I'll explain these concepts in more details in future videos.
Please consider subscribing my channel and turning on the notification bell so you don't miss on these future videos. If you think the content is helpful, please give me a thumbs up and share. And thank you. In my channel, I'm talking about investing, taxes, and personal finance topics.